Look at the data crossing the wires right now. Stop what you're doing and recognize that the cost of silver has exploded by over 109% in a single year. We're looking at an unprecedented systemic failure where industrial demand has finally overwhelmed the paper manipulation of the West. The window to secure your position is not just closing, it is being welded shut by the hands of history. For the better part of the last decade, the global financial structure relied on the illusion of endless liquidity and low-cost raw materials. We were told by mainstream institutions that precious metals were relics of the past, unnecessary in a world of digital derivatives and high-frequency trading. The internal plumbing of our economy was decaying behind the scenes, maintained only by temporary paper fixes, and a refusal to acknowledge the dwindling physical stockpiles of the world's most critical conductors. Historically, the American investor was conditioned to believe that the US dollar was the ultimate safe harbor, and that the everything bubble could be inflated indefinitely through low interest rates and massive debt expansion. We saw brief moments of clarity during the 1970s inflationary period and the 2008 financial crisis, where the market attempted to correct itself by rushing into tangible assets. However, those cycles were eventually suppressed by aggressive central bank interventions. In late 2024, the gears of this suppression began to seize. Geopolitical storms in the Middle East and Eastern Europe started to fray the edges of the global trade network. While the public was distracted by domestic theater, central banks in emerging markets began a silent but massive pivot, diversifying their reserves away from the dollar at a pace never seen in modern history. They weren't just buying gold as a hedge, they were treating it as the new foundation for a post-dollar reality. By the time 2025 arrived, the cracks in the foundation were too wide to ignore, setting the stage for a paradigm shift that would reorder the hierarchy of global wealth. The breaking point arrived in late 2025. On December 15th, a massive data discrepancy crossed the global desk. Silver had surged to an all-time high of 64.66 per troy ounce. This was not merely a price increase, it was a 109.4% explosion from the previous year, signaling that the supply-demand equilibrium had been shattered. But the price was only the symptom. The smoking gun occurred in November 2025, when the U.S. Geological Survey officially added silver to the list of critical minerals. This designation was a quiet admission that the most indispensable metal in the modern world was running out. The gap between what the world needs for its high-tech future and what the Earth is currently providing has reached a state of emergency. We are now witnessing a crime scene in the silver market, where the paper shorts can no longer cover the physical void. Major producers have reacted by reducing their forward sales, a signal of total confidence that the price is not coming back down. The plumbing is now backing up. The inventory of physical silver is tightening to the point of exhaustion, creating a global supply squeeze that is no longer a forecast. It is a verified reality. To understand why this is a system-ending event, we must look at the cold, hard mathematics of the silver deficit. For 2025, the world is facing its fifth consecutive year of silver supply deficits. This is not a temporary hiccup. It is a structural failure of the mining industry to keep pace with the technological revolution. Step 1. The depleting vaults. Throughout 2025, physical inventories have been drained by industrial giants and central banks, leaving the commercial markets with no buffer. Step 2. The dollar's decay. In 2025 alone, the US dollar has depreciated by nearly 10%. This makes every ounce of silver more expensive to acquire for Americans, while international buyers use their local currencies to bid the price even higher. Step 3. The Fed's retreat. The Federal Reserve has been forced into an aggressive rate-cutting cycle, delivering its third 25 basis point cut in the very week leading up to this December peak. The logic is simple and brutal. As the dollar is debased through interest rate reductions, non-yielding assets like silver become the only rational place for capital to hide. However, unlike gold, silver is being consumed at an industrial rate that cannot be stopped. We are in a reflation return scenario, where the liquidity being pumped into the system by the Fed is colliding with a physical wall of scarcity. This is the mathematical point of no return. The arbitrage mechanism, the force that used to keep paper and physical prices aligned, has been turned off because there is simply no physical metal left to settle the paper promises. The ripple effects of this surge are tearing through the international landscape. We are witnessing a transition from a speculative market to a scarcity market on a global scale. In emerging markets like China, Poland, and India, central banks are aggressively hoovering up gold to insulate their economies from the coming dollar collapse. This institutional demand is creating a permanent floor for precious metals, making any significant price correction nearly impossible. In the industrial sector, the impact is catastrophic for companies that fail to secure their supply chains. Electronics and 5G, Global leaders like Apple, Samsung, Intel, and Qualcomm are now grappling with surging production expenses because silver is a vital, non-substitutable component in semiconductors and smartphones. The green energy vacuum. The green revolution is effectively stalling under its own weight. Solar panel manufacturers like Jinko Solar are seeing their margins evaporated by the cost of silver paste, while electric vehicle giants like Tesla and GM are finding that the silver content per vehicle is becoming an insurmountable financial hurdle. This is triggering a wave of resource nationalism. Countries are no longer willing to export their mineral wealth for paper dollars that are losing 10% of their value annually. Instead, they are stockpiling. The global silver-led industrial supercycle has begun, and the world is bifurcating into those who have the metal and those who only have the debt. For the United States, this signifies the end of a 50-year era of financial dominance. For decades, New York and London dictated the price of silver through massive paper leverage, but that authority has been revoked by physical reality in the eastern markets. The U.S. Federal Reserve is now trapped in a doom loop. If they raise rates to save the dollar, they collapse the debt-burdened economy. If they cut rates to save the banks, they accelerate the destruction of the currency. On the corporate front, the U.S. is facing an Achilles heel moment. While mining companies like Barrick Gold, Agnico Eagle, and First Majestic Silver are seeing their share prices soar by hundreds of percentage points, the rest of the U.S. industrial base is being hollowed out. The cost of high-tech manufacturing in America is skyrocketing, which will inevitably be passed on to the U.S. consumer in the form of silverflation. Furthermore, the recent inclusion of silver on the critical minerals list by the U.S. Geological Survey is a warning that our national security is now at risk. Without silver, there is no AI, no advanced weaponry, and no 5G infrastructure. We are seeing a liquidity vacuum where the U.S. Mint and domestic industrial users are competing for the same dwindling ounces, while the rest of the world refuses to sell. We are now entering the boss level of the precious metals bull market. The forecasts for the remainder of this decade are no longer speculative. They are based on the structural reality of a broken system. 2026, the $100 target. Analysts are already projecting that silver will test the 100 mark as the industrial supply deficit enters its sixth year. Gold is expected to push toward $5,000 as the global debt crisis reaches a fever pitch. 2027, 2030, the great re-rating. In the long term, the outlook is structurally bullish. We are looking at silver forecasts ranging from $133 to over $200 per ounce by 2030. Gold is projected to climb toward $10,000 as the world fully retreats from fiat currencies. The new floor for these metals is being established right now. We are witnessing an industrial supercycle, where silver's indispensable role in green energy and advanced electronics will keep prices at elevated baselines for years to come. The era of $20 or even $30 silver is a historical footnote. Oil is no longer the ceiling, it is the foundation for the next leg up. The question you must ask yourself today is not what the price of silver will be tomorrow, but whether you have any at all. We are living through a once-in-a-century structural shift in how value is measured. The transition from paper promises to physical reality is always violent for those who are unprepared. Rules 1. To survive this transition, you must follow 3 tactical rules. Direct allocation. Aim for a 5% to 10% allocation in physical precious metals to insulate your net worth from currency debasement. Rules 2. Mitigate counterparty risk. Move away from paper IOUs and focus on tangible assets or well-managed mining equities with strong free cash flow. Rules 3. Systematic preparation. Use strategies like dollar cost averaging or systematic investment plans to build your position without trying to time a market that is increasingly volatile. Do not be the person searching for a lifeboat after the ship has already tilted. The buy button is still active, but the window of opportunity is disappearing into the vacuum of global demand. Watch the Federal Reserve's guidance and the industrial trends, but above all, trust the math. Stay safe, stay stacked.